Hello and welcome to the Movie Market Podcast. I'm JR Gondeck, as always, joined by David Sokolovsky. David, let's look back to April, sort of a surprising large rally that's kind of shaking the markets, continuing a little bit here in the month of May.
Yeah, Jared, thanks. As we look a little bit into the April recap, but more importantly, looking ahead, essentially had a significant recovery, and essentially most of the major indexes made up all of the losses from the month of March. You saw that the S&P rose 10% in the month and continues to advance into May with a little bit of change in leadership. So the style that was more attractive in the early part of the year has given way to more tech and more momentum, and we'll talk a little bit more about that. Small and international markets performed really well, up 12%. And again, same path, after the end of the month. And as you look at dividend stocks, that's been the one highlight of the, market for the entire year, really. And it continues to be the best performing sector. The question is going to be, can it hold, or will tech and some of the momentum start to overtake it? But one of the things that remains important for us to watch is the conflict in the Middle East with Iran. And as you saw, oil prices initially jumped and stock markets sold off as there was a lot of uncertainty. Then as the oil prices came down, stocks reached their all-time highs, and then oil went back up, right? So oil is pretty much now where it was when the conflict started. Markets were much lower. So it seems that at least the market in the near term is looking past the Iran conflict and really focusing more on the U.S. economy.
Well, and David, as you think about the conflict too, right, of potential headwinds to continue to watch for. I mean, with the strait still more or less closed, it's having challenges on mostly the rest of the world as far as supply. India announced, kind of provisions to have people work from home and drive less to try to help buffer against that. And again, you could see jet fuel and other challenges heading into summer and travel. I mean, fortunately for the U.S., much less of an issue outside of the high price itself relative to where it was. But nonetheless, consumers continued to be fairly resilient despite the fact of where things are. And to your point, investors have looked past most of this as stocks have reached highs in many cases over the last few weeks. And then when you turn, kind of other topics to watch for, the Federal Reserve, change ahead. So you'll see Federal Reserve chair in the month of June. We'll see, what the impact is, but given where inflation, the economy, expectations of rate cuts, not likely. As we turn to the labor market's been more resilient and actually, picking up a little bit over the last, couple of months within the data. And here you could see on the chart over the last year, those last two data points, March and April, which you might have expected some negative jobs with, the conflict overseas, hasn't been the case, overall. And, you continue to see relative signs that the labor market remains fairly resilient.
Yeah, Jaron, I think as you kind of pointed out, I mean, as you look at the last couple months, it's been a strong jobs report and jobs are being created. And will be very important to watch looking ahead because we do see a lot of talk about AI and how it's going to be replacing certain industries, right? Potentially. And so, the jobs number is going to be very important to watch because as larger companies have potential layoffs or can benefit from some of the AI capabilities, that could lead to some, more sustained headwinds in the labor market. But until that happens, you have the consumer, continuing to spend. We see credit card balances rising slowly, right? And you're seeing more use of credit cards, but at the same time, those bills are still being paid. So you're not really seeing defaults ratchet up, which again would be a, kind of a indicator to watch as far as the consumer weakening.
Well, and David, you look at, the article we're about to talk about is, AI replacing jobs, and you see a lot of headlines over the last, few weeks and few months of companies trimming a few thousand here or there, toward AI efficiencies. And if ever you thought there was a, area that would be obsolete, as this article alludes to, radiologists, right, reading and doing things. I don't know if you're going to talk about, kind of this trend, which is interesting.
Yeah, and this has been a topic that was discussed for a long time. So radiology, seemed to be the area that would be disrupted most and potentially the first one with AI because a lot of reading of the radiology reports, right, and the images. And so AI is much better at detecting anomalies, detecting changes, and being able to provide some sort of guidance and recommendation. But ultimately, what you've seen is the ability to perform more procedures, right? The ability for more people to get access to radiologies, and demand is up. So you're seeing jobs continue to increase. The time that a job for a radiologist is open remains relatively short, and their salaries are up to 571,000 a year, which is significant and continues to grow. So I think, as we look at AI, it's going to become more important for us to really dissect and go into what it means for these companies. We see a lot of software companies that have been negatively impacted by AI news, but at the end of the day, I think AI is going to be like any tool and technology that companies use. They have a different way to implement it in their service offering. They have a different way to use it to meet the demands of their customers. And so ultimately, a lot of these software companies will rely heavily on AI to build out the capabilities that they want to see. But you're not going to see, likely see, you know, AI completely replace every single job in the U.S. economy in the near term.
When you look at AI specifically, what's driven the markets the last, 5, 6 weeks pretty heavily, right? And a lot of it is the investment. Earnings across the board were awesome, for the most part, across all industries, right? But specifically when you look at, industries directly or indirectly related to data centers and kind of this huge AI movement have performed even better. But now you're kind of moving, two specific areas, to watch for that have been excess are memory chips and, that area of the market, which is a huge shortage. And, like any a good capitalist, if you look at somebody started a new ETF, a memory ETF, April 1st, and David, look what's happened over the last month in this ETF.
Yeah, well, I think in general, right, you look at even outside of the ETF holdings, the memory space and the chip space has really grown in attention and obviously market cap. But this memory chip ETF, I thought it was an interesting one. So it's up, basically updated through today, it's up over 100% now, and huge concentration. So the top seven names represent over 80% of the index. I think for anybody looking to replicate that in their portfolio, it's very simple, right? It's not a where you're buying 500 companies like you are in the S&P 500. You're really buying seven or eight names to make up for the majority of the index, which is going to be most of the moves. But you see again a lot of the smaller companies in there with very large representation, and that's where some of these ETFs, create concentration risk that people aren't aware of. Because again, as you look at many ETFs, as we talked about over the years, whether it's consumer discretionary with the top two names being over 50%, consumer staples and the like, just because of the size and the market cap of some of these larger companies in the US, where they represent such a big part of the overall S&P, when you further break that down into a specific index, each one of those companies is a much, much bigger share. And so that's where valuation becomes important. And also, not necessarily chasing the trend, because as we've seen, as some of the initial news and exuberance is out there, reality settles in pretty quickly. And as you look at companies like chip manufacturers, right? Pick your favorite one from the last couple decades, essentially became a commodity product, right? So you had processing chips inside of your computer. Most people don't know exactly which one it is, right? But every year a new one comes out, and it essentially becomes a commodity where there's very little margins, very little growth. Right now, it seems like everything is priced for AI completely taking over all of the work, pretty much done by humans today. And so it creates a chart of basically unlimited demand and assumes that it's going to stay there. And at some point, once that demand starts to slow or there's a shift in it, you start to see these prices unravel pretty quickly.
Well, and David, when you look at a nice parallel, maybe you could look at housing, right? I mean, housing market today is pretty static and slow overall, but there's been past periods, shortly after COVID where there's a shortage and a lot of extra demand. Prices go up a lot. Take home builders today. Not an exciting area to invest in right now because housing activity is slow, interest rates are higher. But you go back to the housing boom of the middle 2000s, they made a lot of profit with the shortage. Right. But it doesn't last forever. Right. I think that's what you're seeing. And investors have to be careful chasing some of the crazy momentum that has been in some cases that the shortages and these trends don't last forever, even though in the midst of it, it looks like it can overall. But again, when you look at where do we go from here and kind of summarizing, it's been an interesting, up and down and different movement within the markets. As you started, looking at the chart here, I mean, you have, the orange line is value stocks this year, and the blue line are growth stocks. So if you look, growth stocks started off the year flat and continued down, through the month of March. Since the end of March, you've seen a humongous surge in growth within the market. On the other hand, value stocks have been steady, didn't fall as much in March, and continued to be ahead for the year. But as you can see, David, right, that gap has narrowed pretty aggressively over the last 5 weeks overall.
Yeah, Josh. So the question is, we saw the value outperform in the start of the year. There was a little bit of rebalancing tech. Now a lot of the tech and growth has really been driven by the chips. And again, it's usually a different segment of the market. So there was AI chips that drove it for a period of time, then memory, and then now onto computing power with CPUs. And so we'll see kind of where that trend emerges. But I think it really highlights the importance of having the diversification, having exposure to these different areas, because as we've also seen the retail trade and retail investors, very quickly able to rebalance. I think especially with social media and other things driving just investment sentiment. And so you see, people very quickly being able to shift, get the information, shift into the kind of the popular names. And so as you've seen, growth has obviously powered a big part of the recovery. But looking ahead, you want to stay diversified because again, as that next area emerges, you'll want to take some profit off the table, want to lock in some of those gains. Because again, we've seen some of these parabolic charts, even looking back over the last couple of years, and they very quickly come back down. So the trick is, as you hold these positions and as they increase in value, you still want to keep exposure, you still want to keep some investment there, but also making sure you're locking in gains all along the way up so that you don't watch it, come all the way back down without anything to show for it.
Well, I think as you summarized, David, diversification is key. Can you have exposure and a little extra momentum, at points of your portfolio? Of course. But, as you look longer term and keeping, a steady trend, who doesn't want to double their portfolio in the last 5 weeks? But when you take a step back and say, what risk are you taking to, move and have that kind of risk? And what happens, in the months ahead when you have that amount of concentration? So to us, as always, stay diversified, watch the trends. I think there'll be opportunities within the market, and the economy so far continues to be on pretty even footing with the labor market being resilient. And, for us, stay diversified, and we'll see what happens over the next month, and we'll touch base.
Thank you.